And then on Wednesday, MBS were down 5 basis points on the open. Stocks were up 5 points. The 10-year was pretty much flat. Bonds traded flat in Asia and didn't move much in most of the European session. The biggest mover was at about 7:39 a.m. A headline from CNBC regarding the fire sale on First Republic Bank bonds. With that news alleviating some of the risk aversion bid, bond yields moved up 4 to 5 basis points before drifting back down moments later. The durable goods data was mostly passed without a trace despite a big beat in the headline level. Perhaps the huge downward revision in the core number, which excludes defense and aircraft, offset the headline in traders' eyes. Durable goods rose 3.4% in March, which was well above street expectations. If you strip out transportation, they rose 0.3%. Core capital goods, which is considered a proxy for business capital, fell 0.4% versus a negative 0.4 forecast. It was negative 0.7 previously. Last month was revised down from 0.1 negative. New orders, excluding defense, rose 3.5% in March after negative 0.8 in February. Today's a good day to decide if loans are committed to seeing what the Fed does next week, or else consider locking them today. Loans with lots of time don't have to worry about floating, but risk adverse and loans closing in the near term may see some pullback from recent improvements between now and next week's Fed meeting. The First Republic Bank remains the focus of tradable stuff today and probably into tomorrow a little bit. Yesterday's earnings proved helpful, but today's headlines were mostly pushed back in the other direction. Overnight news on bond liquidation efforts put pressure on the broader bond market for supply related reasons. Basically, the market is saying that FRC is probably going to have to dump a whole bunch of mortgage-backed securities on the market, which will increase supply and make things kind of screwy. So at the end of the day, we ended up being down 20 basis points, ending up at 100.67. 100.67 were right beneath that big bold red line at 100.756, with a floor down at 100.393, which there's three ceilings on the top of that, and it's a fairly narrow range. As the date of the U.S. Treasury will hit debt ceiling approaches, investors are increasingly taking note. The cost of a one-year U.S. sovereign credit default swap that pays out should the U.S. default occur has risen from a typical 10 basis points to 140 basis points and is rising exponentially. So basically, the market is banking that there will be some sort of a credit default by the U.S. on its Treasury sometime this summer. The NBA's Joel Kahn also added some stats on fundings over the last year. So we had a total of 13.7 million fundings in 2020, 14.2 million in 2021, 6.4 million in 2022, awaiting final HMDA data in June, and we're forecasted to be about 5 million in 2023. That puts 2023 fundings at about 1/3 that of 2021, although that was a pretty rock solid banger of a year.